Hey there, savvy investors and financial explorers. Welcome back to the channel. Today, we're diving deep into a fascinating corner of the market, hard to borrow stocks and the mechanics behind a potential short squeeze. We're going to break down why certain stocks become incredibly expensive for short sellers to bet against, and what that could mean for their price action. And we're doing it by looking at a very specific, real-world example that's been popping up on our screener, Global Interactive Technologies, Inc., trading as GITS. Get ready to understand the forces at play when borrowing costs skyrocket. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Show company logo/info. Let's zoom in on GITS, or Global Interactive Technologies, Inc. This company operates in the communication services sector, specifically within internet content and information. Through its subsidiary, GITS runs Fining, a digital fan engagement platform designed for online fan communities in South Korea, focusing on content discovery, sharing, and user interaction. It's a micro-cap stock, currently sitting at a market capitalization of just $7.09 million. Looking at recent price action, GITS was down -2.73% today. Over the last 5 trading days, it saw a modest gain of plus 0.94%, but looking at the last 30 days, it's down -7.76%. Volume-wise, today saw only 13,100 shares traded, a stark contrast to its 30-day average volume of 1,339,830 shares, meaning its relative volume today was practically zero x average. What is cost to borrow and why it matters? Geographic CTB explanation. So, what exactly is cost to borrow, or CTB? When a short seller wants to bet against a stock, they first have to borrow shares from someone who owns them. They then sell those borrowed shares, hoping to buy them back later at a lower price, return them to the lender, and pocket the difference. But borrowing isn't free. Short sellers pay a fee, known as the cost to borrow, or CTB. This fee is typically expressed as an annualized percentage of the value of the shares borrowed. When a stock becomes hard to borrow, it means there are very few shares available for lending. This scarcity drives up the CTB fee, sometimes to astronomical levels, well over 100% annually, making it incredibly expensive to hold a short position. High CTB signals strong demand to short a stock, but more importantly, it can also signal a drying up of available shares, which is critical for short squeeze potential. Why this stock is hard to borrow right now? Show GITS CTB data. Now, let's look at why GITS Global Interactive Technologies, Inc. specifically caught our attention. The cost to borrow fee for GITS is currently an astonishing 967.4% annualized. Think about that, short sellers are paying nearly 1,000% of the stock's value each year just to hold their positions. And this isn't a static number. We've seen significant CTB momentum with an increase of plus 56 percentage points over just the last 5 trading days. This rapid surge indicates growing pressure. Adding to the squeeze potential, there are only 500 shares currently available to borrow across our tracking platforms. Compare that to the estimated float of 2.4 million shares. With such a minuscule supply against the float, it's clear why shorting GITS is so difficult and costly right now. Our internal composite squeeze score, which factors in CTB levels, momentum, borrow supply, float size, and price action, currently pays GITS a 45.4 out of 100, a notable score for a microcap with these dynamics. Squeeze mechanics explain. Show animation, short squeeze mechanics. So, what happens when a stock like GITS becomes this hard and expensive to short? This is where the mechanics of a short squeeze come into play. When borrower fees climb into the hundreds of percents and the supply of borrowable shares dwindles to almost nothing, like the 500 shares for GITS, short sellers face immense pressure. They are losing money daily just to maintain their short positions. If the stock price starts to rise, even a little, the short sellers may be forced to cover their positions. Covering means buying back the shares they initially borrowed and sold. This buying pressure, initiated by short sellers, can then push the stock price even higher, triggering more short sellers to cover, creating a cascading effect, a short squeeze. It's a powerful feedback loop. However, it's crucial to remember that a high cost to borrow does not guarantee a squeeze. It can also signify that short sellers have very strong conviction in their bearish thesis and are willing to pay those exorbitant fees, believing the stock will eventually fall significantly. Dilution risk check. Show graphic, dilution explanation. One of the biggest risks that can negate a short squeeze, even with high cost to borrow fees, is dilution. Dilution occurs when a company issues new shares, increasing the total number of outstanding shares. This dilutes the value of existing shares and can flood the market with new supply, providing short sellers an easy way to cover their positions or making it easier for new shorts to enter. For GITS, we've conducted our dilution risk check. We found no recent dilutive SEC filings such as -1s, -3s, or 424BS in the last 90 days. Furthermore, there has been no recent reverse split for GITS in our look-back window, which can sometimes precede or be linked to dilutive events. This lack of recent dilution is a positive factor for a potential squeeze thesis, as it removes one significant hurdle. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Show GITS chart with volume bars. If you're watching GITS Global Interactive Technologies Inc. closely, here's what you should keep an eye on. Firstly, volume. With today's volume at only 13,100 shares compared to a 30-day average of over 1.3 million, a significant uptick in trading volume could be a key indicator. Look for a sustained increase, not just a one-day spike. Secondly, continue monitoring the cost to borrow and the supply of shares available to borrow. Any further increase in CTB or decrease in available shares would intensify the pressure. Given the estimated float of 2.4 million shares and the current microcap status, GITS has the characteristics where a sudden increase in demand could have a noticeable impact due to its relatively low liquidity. Show channel end screen. So, that's a deep dive into Global Interactive Technologies Inc. GITS, and why it's appearing on hard-to-borrow screeners with a stunning 967.4% annualized cost-to-borrow fee. It's a compelling example of how market dynamics and scarcity can create unique situations for investors to study. Remember, understanding these mechanics is key to navigating volatile markets, but always exercise caution and conduct thorough due diligence. This information is purely for educational purposes, helping you understand the forces at play. If you found this breakdown valuable, hit that like button, subscribe to the channel for more unique insights into market mechanics, and let us know in the comments below what other stocks or financial concepts you'd like us to explore next. Thanks for watching, and we'll see you in the next video.